Yesterday, the Indian stock market witnessed a dramatic drop in the India VIX index. This plunge of over 20% marked the sharpest single-day decline in 5 years. But what exactly is the VIX? And what does this sudden dip signify for investors? Let's discuss this. The India VIX, also known as the Fear Index, is a volatility gauge for the Indian stock market. It reflects investor sentiment and essentially measures how much market participants expect stock prices to fluctuate in the near future. A higher VIX indicates greater anticipated volatility, and likewise a lower VIX indicates low expectations of volatility. This index is computed by NSE based on the order book of Nifty option contracts of the near and next month Nifty option prices. So in context, the 20% drop in VIX, the biggest single day fall in 5 years, stunned market participants as it came ahead of key events such as the general elections and the US Federal Reserve's policy meeting. Even if you look at the history of steep declines in the VIX index, it had come when the general elections were announced. If you look at the chart in 2014 and 2019, it dropped by almost 34% and 30% respectively on the day of the results. The recent drop of over 20% can be attributed to a few factors. Firstly, the current polls are hinting at the likely return of the current party in power. This is a big deal because what markets really like is stability. Knowing that the same party might continue means less uncertainty about drastic policy changes. With the recent general elections potentially leading to a stable government, investors might be factoring in a period of policy continuity. Several indicators like the Q3 GDP growing at 8.4%, indirect tax collections growing at 17.7% in fiscal 24, and positive earnings by companies for the fourth quarter are all aiding to the positive sentiment in the market. Moreover, India's retail inflation has eased off to a 10-month low, landing at 4.85% in March 2024. This dip comes as a breath of fresh air after enduring months of inflationary pressure. Another reason could be the reduction of lot sizes of Nifty options contracts from 50 to 25 starting from the May expiry, which is likely to increase liquidity and reduce the bid-ask spread of call and put options, which could have led to a fall in the fear gauge. Lastly, a potential de-escalation of global tensions with Israel-Iran up to multiple airstrikes and retaliation is now on the cards, adding to the positive sentiment. To conclude, while a lower VIX is generally seen as positive, it is imperative to avoid making impulsive decisions. And rather than making conclusions on one-day move, investors can watch if India VIX sustains at lower levels in the next 3 to 4 sessions. Having said that, this is me, Ralison, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.